We're going to look at why hedge fund managers earn so much money. You've probably read in the news about the sort of earnings that hedge fund managers are making, and this video will explain exactly how they're doing that. So let's start by looking at how much they're actually taking in. Well, it's really insane how much these people can make. You see, the great statistic is that the top 25 hedge fund managers are out earning all of the S&P 500 CEOs combined. That includes people like Procter & Gamble, Coca-Cola, General Electric, Disney, and we all know that those executives are paid very highly. You see, they can run into billions of dollars per year. You have quite a number of hedge fund managers who've consistently earned over $1 billion per year for quite some time. But of course, the money is concentrated at the top. Not all hedge fund managers are making these insane numbers. The top hedge fund managers take a disproportionately large share of the hedge fund industry. So let's look at some of these people. At the very top, you've got the normal sort of names you come to expect if you read these lists. People like George Soros has always been among the top earners. People like Steve Cohen of SAC have always been highly paid. You've got people like John Paulson. If you want to know more about John Paulson, the book to read is The Greatest Trade Ever. You've got the maths professor, James Simons, who has a massive computer that trades stocks very effectively. And then you go all the way down to the bottom to the guy that just made the list, and he only got 280 million. So let's look at how it's actually done. And it's a very simple step-by-step procedure. So the hedge fund manager compensation is usually 2% of assets each year, and then 20% of the profits. So they invest your money, you take on the risk, but they get 20% of the profits that they generate. So the hedge fund runs a large amount of money, usually several billion. So the performance fees that they're charging are going to be very high. 2% of several billion is a big number. Then the hedge fund generates a return, and then it charges performance fees on that return. And if the returns are high, 20% of the returns generated by a very large amount of money is a very large amount of money. And also, these hedge fund managers are very wealthy. They've been doing this a long time, and they invest alongside their investors, so they can have a very large amount of money invested in their own funds. So they make a lot of money investing with their investors. So let's look at a good year for a hedge fund. It's not a spectacular year. So we've got this big hedge fund. It's got 10 billion in assets, and it returns 20%. Let's see how the compensation works out. So the fund takes 2%, so 200 million goes in from the normal fees. Then the performance fee comes to 400 million. So the fund earns 600 million. That's the revenue. And of course there's expenses in running the fund, but the profit margins of hedge funds are very high. And of course, as I said, the hedge fund manager will have his own or her own money invested. And when you add that in, that takes that 600 million even higher. So here's a silly example just to illustrate the fee structure of hedge funds. So you got this guy Brian decides to launch a hedge fund and amazingly manages to take in $10 billion. I know, told you it was a silly example, but let's see it play out. So just decides just buy the S&P 500. Not doing anything clever, just tracking the market. And the rest of the year he just sits in the pub and lets it do its thing. And then at the end of the year, he collects a salary for managing this fund, just tracking the market. A lot of hedge funds are really just tracking the market return and usually underperforming it. So let's look at Brian's salary. His return's about 30%. 2013 to 2014 is a very good time to be invested in the S&P 500. He's done very well. And he takes in 200 million just for having the 10 billion under management, and then 600 million of performance fees. So in total he earns 800 million for just tracking the market. Of course, you couldn't set up a hedge fund that just bought the S&P 500. But if you do just buying the S&P 500 in a slightly more sophisticated way, you can usually earn these very high amounts of money. So the point is, hedge funds make money because they're hedge funds. They are structured in such a way that the people that run them get enormous compensation, and it's this 2 and 20 fee structure that achieves it. There's a good reason why people like Terry Smith, who's a very good money manager, says that you should never pay performance fees. When you look at the mathematics of performance fees, you'll see how bad they are, how much money you actually lose through them. And I would also recommend that you look up the book More Money Than God. It's probably the best book that's been written on hedge funds. It's very, very good. And as you probably know now, that is the perfect title for it. And let's just summarize the points that we've made. What you see on the screen now is the formula for making enormous amounts of money in a hedge fund. It's very simple, but very difficult to apply in practice. The difficult part is getting lots of assets under management. You have to convince people that you're very smart and you should be managing billions and billions of their money. That's a difficult part. But once you've got that, the insane earnings just follow on their own. You've got lots of money at very high fees, which lets you build up a very large personal fortune, which you invest and continue to get very, very large amounts of money even after you've finished running the hedge fund, because you've got such a large amount of money to yourself. So there you have it. That's how hedge fund managers earn so much money. Thank you for watching.